Hello and welcome. Thank you for watching my presentation. At our recent meeting, there were a number of concerns raised. I would like to address those concerns with you now. First and foremost, I'd like to explain the analysis method I used to calculate our current surplus, or more accurately, a lack of current surplus. I used a technique known as cost volume profit analysis. This is an accounting technique that is used to see what will happen to costs, revenue, and profit if we change the volume of sales, or in our case, the number of participants. Cost volume profit analysis can also be used to determine how our profit will change if we alter selling prices, costs, income tax rates, or our mix of products, which is the relative number of participants in each program. Let me illustrate with a diagram. This graph represents our cost volume profit scenario. Let's start by looking at our costs, and we'll begin with fixed costs as represented by the fixed cost line. We need to pay these regardless whether we are full to capacity with participants or if no participants arrive at all. In addition, each participant has a cost associated with them, which are the costs to cover outdoor supplies and food. These are known as variable costs because the total cost varies with the number of participants. As the number of participants increases, the costs increase, as can be seen by the red total cost line in the graph. If we have no participants, we have no revenue, and our total revenue will continue to increase with an increasing number of participants, as shown by the blue line. Notice that the blue line starts below the red line because of our fixed costs. Eventually, the blue line will cross the red line. At the point where the two lines converge, our total revenue will equal our total costs. In other words, we will just be covering our costs. This is known as the break-even point. For participants below this number, we will lose money. For participants greater than this number, we will make a profit. Cost volume profit analysis allows us to calculate exactly what the break-even point is and what the total revenue is at break-even. These are the original figures I presented at the meeting. I need to draw your attention to one number, the total number of participants, which is highlighted in red. From our meeting, I learned that 115 participants is the actual maximum we can accommodate at present. The problem with this number is that this is the break-even point for the number of participants. If we lose just one participant, we will be losing money. In addition, because we're at the break-even point, we are barely making a surplus at this level of participants. This is not enough money to pay for the painting and minor renovations that you are looking to have done, Ms. Grant. I would like to point out that I have used weighted averages for the fee per participant and variable cost per participant. This was also a cause for concern at our meeting, and I'd like to take a moment to explain this concept. A weighted average is similar to a normal calculation of an average, but it allows some items to carry more weight than others. Let's look at our fee per participant as an example. With a standard average, we would simply add all of the fees together and then divide by 3 the number of different fees to give us an average of $5,270 per participant. This would be fine if each program had the same number of participants, but as we can see, this is not the case, and therefore this average is not correct. However, for a weighted average, we take into account the relative number of participants, as can be seen with the new calculation. We also divide by the total number of participants to arrive at the correct weighted average of $5,113 per participant. I performed a similar calculation for the average variable cost per participant. Now, having listened to all of your concerns and requirements at the meeting, I have revised the cost analysis which I present here. First, I was able to increase the participants in the rock climbing and trekking and the canoeing and kayaking programs as discussed with Mr. Huang and Ms. Desai. Since Ms. Bisson said that you could not accommodate any further participants, I've left them at 50. I've taken into account the salaries for the additional trainers. These have been added as fixed costs to the relevant programs because the cost does not vary with the number of participants. Once you've hired the trainers, you need to pay their salary regardless the number of participants. I've also added 5% to the outdoor supplies portion of the variable cost per participant. Finally, I've allocated $10,000 as fixed costs for the period for painting and maintenance. I've divided this cost across the 3 programs using the relative number of participants, utilizing the same method I used to calculate the weighted averages. As you can see from the bottom line, we are now in a position to make a healthy surplus even after absorbing the cost of painting and maintenance. This graph represents the revised situation. Although the break-even point is similar in terms of the number of participants, we are now in a far better part of the graph. This provides us a safety buffer, and we do not need to be concerned if we have a few participants that don't arrive, as we are well above the break-even point. To recap, I started by explaining the cost volume profit analysis technique I used in my calculations. I then presented the current program cost analysis and demonstrated the problem we have at present. We are operating right at the break-even point. I briefly explained what weighted averages are and how I used them in my calculations. Finally, I presented a revised program cost analysis taking into account all of the feedback received at our meeting. I trust that you all feel far more comfortable with these figures. Thank you all for your time and attention, and have a great Oz Adventure Day.